implications for Saudi Arabia. Turning to the implications of the crisis for Saudi Arabia, let me re-emphasize the significance of macroeconomic stability for a competitive and hospitable investment environment. And I am reminded by the statement of my colleague, Minister Al-Assaf, this morning, and the way he elaborated on all the measures that have been taken in Saudi Arabia. We at SAMA, the central bank, in coordination with our colleagues at the Ministry of Finance, have ensured sustainability of macroeconomic stability through counter-cyclical fiscal measures, flexible monetary conditions, and a stable exchange rate. Consequently, Saudi Arabia remained relatively insulated from the process of financial engineering of toxic instruments. Our banking system was not in need of official financial support. In the years before the crisis, we repaid most of our government debt. So at the macroeconomic level, our public finances, as Minister Al-Assaf emphasized today, are reasonably sound despite the 45 billion riyal budget deficit in 2009, resulting from the government's aggressive counter-cyclical fiscal policy under the current circumstances. One, bankers will need to continue with rigorous stress tests of bank balance sheets. Two, governments must anchor fiscal policy in a credible medium-term framework that addresses sustainability concerns. Three, financial regulators have to press ahead with a carefully sequenced introduction of reforms as the recovery continues. Fourth, central bankers need to integrate a macro-prudential dimension into their policy. Fifth, economists of the dismal science need to rethink their model-based approaches that gave no warning of the impending crisis. Above all, we must be realistic and pragmatic after this terrible warning so that making policy and investing money alike are based on realism as opposed to illusion and complacency. To sum up, macroeconomic stability is paramount for providing a competitive investment environment.
We see many of the banks taking further provision, doing stress testing, as the governor just outlined, and also probably seeking more capital moving forward in the year 2010 to improve their capital adequacy ratio. We should expect things to stabilize. And as the problem started within the banking system in the region, it has to end at the banking system. Until we see our banks healthy again with proper capital adequacy and with proper provisioning and much better managed loan book portfolio, and see them back lending into the system back again, then I think we can see the first signs of recovery.
I think what we have seen in 2008 is one of the, if I may say, without shocking a lot of people, is one of the greatest robberies of all time. It happened live on TV in front of everybody, and the taxpayers in all over the world are paying the price for the lack of governance, lack of business model of global financial institutions. And today, we are active in the marketplace, and we're seeing all of these global banks making the same, not necessarily mistakes, but their behavior hasn't changed. I think that there is an inherent conflict of interest in financial intermediation today, and that needs to be resolved by government intervention and not by, well, we can self-regulate ourselves.
I, for one, do think that there are substantive changes taking place, at least when I look across the business community. There are a number of what I would describe as major management themes that are evolving. One is what I would describe as getting back to basics, getting back to fundamentals. There is a significant focus on managing of cost structures, supply chains, cost efficiencies, both in developed as well as in developing territories, one that I think in the era of all this exuberance we lost.
I would disagree a little bit with Hassan in terms of that we haven't learned much and that we're back to our old ways. If I may, John, I mean, just by way of backdrop, the excess in the monetary policy excesses in the monetary policy was what I would refer to as the original sin, holding rates too low for too long. It turned a good idea into a bad one, creating a titanic housing bubble. And then we've had 4 distinct crises as a result: a mortgage crisis in the US and the world, a capital markets crisis with 2 major firms disappearing, and the third morphing into Bank of America, a third, a global credit crisis, and last, a severe global recession. To answer Hassan's question, what did we learn? I think first what we learned is credit underwriting has to begin with sound diligence practices. The rating agencies aren't substitutes for independent and rigorous risk analysis. Second is leverage is an important factor for both financial institutions as well as consumers, and it's a potential source of instability. An economy built on spending or speculation cannot be stable as one built on production. Markets and regulators can't tolerate leverage of 40 to 60 to 1 as we had before. At the start of the crisis, one of Bear Stearns' funds was leveraged 100 to 1. So I think the leverage played a key role in the crisis that we went through. Third is liquidity. And liquidity is critical to financial institutions. It allows us to make margin calls, meet margin calls, fund redemptions, or pay depositors. Fourth is simplicity. In any financial product is a virtue, and it can't be assumed that structured products will continue to behave in crisis as they do in good times. Fifth is undiversified, pure play financial institutions, which is, I think, a key component of what we learned, just can't function as a standalone entity. Had a lot of the standalone investment banks been affiliated with universal banks, we wouldn't have had a lot of the issues. And last is compensation incentives are important and should match the duration of the risk taken to produce a profit.
Debt in and of itself is not really the problem. It's the ability to repay, generate enough value added and enough income in an economy through production, through taxation, to repay that debt. So if you look at the US now, the debt ratio could reach up to 60%. That is within the Maastricht agreement if it were a member of the European Union, and therefore it's not big of an issue. However, if the economy deteriorates and the recovery does not pick up, and the production process in the US economy does not generate sufficient income to contribute to the repayment of that debt, then the fiscal problem and the saving rate in the US economy will suffer significantly, and it will have spillover effects to the rest of the global economy.
I mean, prudent debt is not a bad word. Prudent debt is what helps to develop a middle class. So debt used wisely, both by governments as well as people worldwide, that's the success story to me of the GCC countries, of the emerging countries, of China, of India. So I think debt used wisely is very good for economic prosperity.
Our regulatory regime was considered as not so exciting to people because we had pro-cyclical capital buffers when nobody thought they were needed. We had leverage ratio when they thought it was intrusive. We had liquidity ratio when they thought we didn't know what we were doing. And lo and behold, when the crisis hit, everybody now is asking about these things. And actually, as I mentioned in my intervention earlier, if you read the governing board of the Basel Committee last communique only 2 weeks ago or less, and the Financial Stability Board's communique, you will see that these elements are important and they have to be dealt with in all countries. Otherwise, you will fall into the trap of regulatory arbitraging, which was one of the problems we had also earlier going into the crisis. So yes, you need all of these elements. I mean, there is no magical solution where you just switch it on. You need regulators to understand what regulatory prudence means, and you need management